The average £1.5 million estate that goes into a discretionary trust pays about £70,000 every 10 years in tax. But that same estate would hand HMRC nearly £500,000 if you do nothing. Think about that for a second. £70,000 every decade sounds like a lot of money. And yet every article, every advisor meeting, every forum post seems to focus entirely on avoiding that charge, without once showing you what the alternative actually costs. So why does almost everything you read about trusts scream, avoid the 6% charge, and never show you the comparison on the other side? In this video, I'm going to run the real numbers side by side. The 10-year charge, the exit charges, the legal costs, versus the inheritance tax bill your children would face if you did nothing. By the end, you'll know exactly when a trust is worth it and when it genuinely isn't. That comparison is what HMRC doesn't tell you. Because if you did the maths yourself, you might decide you don't need their help collecting £470,000 from your estate. If you're near retirement and you own a home or have savings that push you over the inheritance tax threshold, this is exactly the kind of breakdown you need before you sit down with a solicitor. That's what this channel is about, the numbers behind the advice, not just the advice. So if you haven't already, hit subscribe now so you don't miss the next one. Let me show you the maths straight away, because this is where everything starts to make sense. The 10-year charge on a discretionary trust is 6% of the trust's value above the current nil rate band of £325,000. Take a trust worth £1,500,000. The amount above the threshold is £1,175,000. 6% of that is £70,500, paid every 10 years. Now take the same estate without a trust. After your death, the estate pays 40% inheritance tax on everything above £325,000. That's 40% of £1,190,000, which comes to roughly £476,000. One single payment to HMRC when you die. So you're comparing £70,500 every decade against a £476,000 one-off bill. Over a normal 20 to 30-year period, the trust wins decisively. That's the calculation most people never see. Now here's what makes this a trap rather than just a gap in knowledge. If you've ever sat through a meeting with a financial advisor who said, "Trusts are too complicated, just avoid them," you're not alone. I've heard that said many times. And the advisors who say it aren't necessarily wrong about the complexity. Trusts do involve ongoing admin, annual accounts in some cases, and a registered relationship with HMRC, but complexity is not the same as cost. When an advisor steers you away from a trust because they don't want the compliance headache, the bill doesn't disappear. It just moves. It moves on to your children in the form of a six-figure inheritance tax payment. So who benefits from that advice? HMRC collects more. The advisor avoids a difficult conversation, and the simpler product, a straightforward will with no trust, gets sold instead. The result is that many people in their 60s either avoid trusts entirely and pay the full 40% rate, or they set one up poorly, using the wrong type of trust or funding it at the wrong time, and end up with a structure that doesn't actually reduce the bill. There's a related issue worth naming. A lot of the content you'll find online focuses almost entirely on how to avoid the periodic charge. It's a real cost, so that attention isn't wrong, but when it dominates the conversation, it creates a distorted picture. You hear about the £70,500 charge, and you don't hear about the £476,000 saving sitting on the other side of the ledger. That framing matters, because fear of an immediate cost is very effective at stopping people from acting. And if you don't act, HMRC gets a much larger amount later. It's also worth being clear about what the nil rate band actually is. Every estate in the UK gets £325,000 completely free of inheritance tax. If you're married or in a civil partnership and your spouse dies first, their unused threshold can transfer to you, which can double it to £650,000. There's also a residence nil rate band of £175,000 if you're passing your main home to direct descendants like children or grandchildren. But beyond those thresholds, the 40% rate applies, and the nil rate band has been frozen at £325,000 since 2009. It's currently frozen through to 2030 under existing government plans, so inflation alone means more and more estates are being pulled into the inheritance tax net every year. On a £1.5 million estate, which is not uncommon in parts of England and Wales once you include a family home, a simple will with no trust structure leaves around £476,000 sitting in HMRC's hands. A well-structured trust, paid for and maintained properly, reduces that figure considerably, so the trust can save hundreds of thousands of pounds, but it only does that if it's set up correctly, at the right time, with the right type. And that's where most people get it wrong, not because they're careless, but because nobody ever showed them a proper side-by-side comparison. That's what we're going to do next. Whenever I assess whether a trust makes sense for someone, I do one thing before anything else. I build a simple two-column comparison. On one side, I put every cost the trust will generate over the next 20 years. The setup fee, the 10-year charges, any exit charges when money leaves the trust, and a rough allowance for ongoing admin. On the other side, I put the inheritance tax bill the estate would face if there were no trust at all. If the right-hand column is bigger than the left, the trust wins. It's not more complicated than that, at least not at the first-pass level. I'll be honest with you. A few years ago, I would have told people not to bother with trusts unless they had very large estates. I thought the compliance burden wasn't worth it for most people. Then I sat down and ran the full numbers on a few real-world cases, including one involving care home fees, which I'll come to in a moment, and I realized I had been looking at it the wrong way. I was giving too much weight to the 10-year charge and not enough weight to what happens on the other side if you do nothing. That's when I started using the two-column comparison as a standard tool. So let me run it here, using the same estate we looked at in the last section. Let's say you have an estate worth £1,515,000, a family home worth around £800,000, and the rest in savings and investments. You're 65. A solicitor sets up a discretionary trust for you, which costs around £3,000 in legal fees. At year 10, the trust pays its periodic charge, 6% of the value above £325,000, which comes to approximately £70,500, assuming no significant growth for simplicity. At year 20, assuming the trust is still running, it pays another £70,500. When the assets are eventually distributed to your beneficiaries, there may be an exit charge, roughly £35,000 in this illustration. Add it up, and your total trust cost over 20 years is approximately £179,000. Now the other column. Without a trust, your estate pays 40% inheritance tax on everything above the nil rate band of £325,000. That's 40% of £1,190,000, which is £476,000, paid in one go after you die, before your children see a penny. The comparison looks like this. Total trust costs over 20 years, £179,000. Inheritance tax without a trust, £476,000. Net saving, just under £300,000. And that's a simplified illustration. It assumes no growth in the estate, which is conservative. In practice, if the trust assets grow, the 10-year charges increase proportionally, but so does the inheritance tax saving on the other side. The comparison generally holds. Now, I always add two caveats when I show this to people. First, these figures assume the trust is set up and maintained correctly. An incorrectly structured trust, or one that doesn't meet HMRC's requirements, can lose the tax benefits entirely. You need a qualified solicitor who specializes in trust work, not a general practitioner who does it occasionally. Second, the numbers look different for smaller estates. If your estate is £500,000 and most of it is covered by your nil rate band and residence allowance, a trust may not save much at all. The comparison still applies, but you need to run it for your actual numbers, not a hypothetical. The point is, the decision should never be driven by fear of the 10-year charge in isolation. Most trust advice scares you with the periodic charge and never shows you the saving on the other side. Once you see both columns side by side, the conversation changes completely. So the numbers say trusts can make sense. But that's only half the story. The other half is what happens when life doesn't go according to plan. The two-column comparison I showed you works well when everything goes according to plan. But let me add a third dimension that most people don't think about until it's too late. Imagine you're 80 years old and you need residential care. In England, the average care home fee is around £1,500 per week. That's roughly £78,000 a year, according to Age UK's 2026 figures. A 5-year stay costs nearly £390,000. And under the current means testing rules, the local council will assess all of your capital before it contributes a penny. If your estate includes a house worth £500,000 or more, that house is in scope. You'll be expected to use it, either by selling it or by arranging a deferred payment, before any council funding kicks in. Now consider what happens if that same house is sitting inside a discretionary trust that was set up properly, well in advance. The trust owns the asset. The council assesses your personal capital, not the trust's. Provided there is no evidence of deliberate deprivation, meaning you didn't put the asset into the trust specifically to dodge care fees, the trust structure may protect that capital for your beneficiaries. But here's the part most advisors get wrong, and it's the part that really matters if you're considering this. There is no fixed look-back period in English care fee assessment. Unlike some other countries, England doesn't have a hard 6-year or 7-year rule. Instead, councils apply a deliberate deprivation test. They look at when you transferred the asset, what your health was like at the time, and whether care need was reasonably foreseeable. If you were 78 and already had mobility problems when you put your house into a trust, the council may conclude that care need was foreseeable, regardless of how long ago you did it. If you were 62 and in good health when you set up the trust, with no particular indication at that point that care would be needed soon, the argument for protection is much stronger. The timing, in other words, is everything. A trust set up in your 60s for estate planning purposes stands on much firmer ground than one set up in your late 70s after a health scare. This is not legal advice. Your situation will depend on your specific circumstances, and you should take proper legal counsel. But the general principle holds: the earlier you act, the cleaner the position. So you get two potential benefits from one structure. The trust reduces your inheritance tax exposure on one side. On the other side, it may protect assets from care fee means testing, but only if it was set up far enough in advance that no one can argue it was done to avoid an imminent care need. That dual benefit is what most people who dismiss trusts as too complicated never hear about. So if the numbers work and the timing matters, what does a sensible process actually look like? Let me walk you through the 3 things you need to get right. The first is timing, and specifically, your current health position. If you're in your 60s, in reasonable health, with no diagnosed conditions that would suggest a care need is on the horizon, you're in the strongest possible position to set up a trust. The further your current health is from any foreseeable care need, the cleaner the deliberate deprivation argument becomes. Some people ask their GP to include a note in their records confirming there are no current conditions that would anticipate imminent care needs. That's not a formal process. It's just good documentation. You're creating a contemporaneous record that supports your position if it's ever questioned. If, on the other hand, you already have a condition that might lead to care need in the near term, a trust may not protect your assets from means testing, but it may still reduce your inheritance tax exposure. Those are 2 separate questions. Don't assume that because care fee protection isn't available to you, the trust is pointless. The second is choosing the right type of trust for your situation. A discretionary trust gives your trustees full flexibility over how and when assets are distributed to your beneficiaries. It's generally the most effective structure for inheritance tax planning, and it's what most people mean when they talk about putting assets into a trust. But it does trigger the 10-year periodic charge, the 6% we've been discussing. A life interest trust works differently. The named beneficiary, typically a surviving spouse or partner, has the right to benefit from the trust during their lifetime. When they die, the assets pass to whoever you've named as the remainder beneficiaries. This structure is common in second marriages, where someone wants to ensure their spouse can remain in the family home while also protecting the children's inheritance. A bare trust is simpler and cheaper to run, but it gives your beneficiaries an absolute right to the assets. Once it's set up, you can't change your mind about who gets what. That lack of flexibility makes it unsuitable for most people doing estate planning. For most straightforward inheritance tax planning situations on an estate above £500,000, a discretionary trust is typically the first option to explore. But the right choice depends on your family structure, your assets and your intentions, which is why a specialist solicitor, not a generic one, is worth the extra cost. The third is registering the trust with HMRC. Under the Trust Registration Service, almost all UK trusts must now be registered. You have 90 days from the date the trust is created to complete registration. Miss that deadline and penalties can apply. Once registered, you have ongoing obligations to keep the details up to date. Changes to trustees, changes to beneficiaries, and changes to the trust's assets all need to be reported. This is where a lot of people get into trouble. They set the trust up once, pay the legal fee, and then treat it as a done deal. But a trust is a living structure. It needs to be managed, reported on, and kept current. That's the compliance overhead that makes some advisors reluctant to recommend it. But if you factor that cost into your two-column comparison, which it already is in the £179,000 figure from earlier, you'll see it doesn't change the conclusion. To recap the numbers, on a £1.5 million estate, the inheritance tax without any trust structure is around £476,000. The total cost of a well-maintained discretionary trust over 20 years, including setup, 2 10-year charges, and an estimated exit charge, is roughly £179,000. That's a net saving of around £297,000. Approximately 30% of the estate preserved, rather than handed to HMRC. And yet, even when people see those numbers clearly, many still don't act. That says something interesting about how we make decisions, which is what I want to cover next. I've shown you the numbers. The comparison is fairly clear, and yet, when people actually sit down to make the decision, something strange happens. A significant number of people who understand the maths, who have seen the side-by-side comparison, who acknowledge the saving is real, still decide not to go ahead. And the reason isn't more information. It's how the two costs feel. The £70,500 10-year charge feels very real. It's a payment you make out of the trust on a specific date in the near future. Your brain registers it as a loss. The £476,000 inheritance tax payment, on the other hand, happens after you die. Your children pay it, not you. It's abstract, distant, and easy to put to the back of your mind. This is a well-documented psychological pattern called loss aversion. We feel the pain of losing something roughly twice as strongly as we feel the pleasure of gaining the equivalent amount. A £70,000 payment today feels worse than a £470,000 saving feels good, even though the arithmetic obviously favours the saving. There's also a second thing going on with property in particular. I've seen this many times. Someone knows intellectually that putting their house into a trust doesn't mean they lose control of it. They can still live there. The trustees are typically family members. Nothing changes day to day. But it doesn't feel that way. The house has been theirs for 30 years. Transferring it to a legal structure feels like letting it go, even when nothing in their daily life actually changes. Behavioral economists call this the endowment effect, we place extra emotional value on things we already own, and the act of transferring them feels like a loss even when it isn't. I understand both of those feelings. I get why someone says they know they should sort this out, but can't quite bring themselves to do it. That's a completely normal reaction. But here's a way to reframe it that I've found genuinely useful. You're not paying £70,500 in 10-year charge. You're investing £70,500 to protect £297,000 of your family's money. For every pound you put in, you're saving roughly £4 on the other side. You wouldn't turn down a savings account that paid 400% interest, but that's effectively what the numbers describe. So what's the final picture? Let me bring it all together. Let me sum up what we've covered. A discretionary trust is not a magic solution. It's not right for everyone, and it's not something you could set up badly and expect to work. But for a £1.5 million estate, the numbers are not subtle. The 10-year charge comes to roughly £70,500 per decade. The inheritance tax without any trust is roughly £476,000 paid once. Over a 20-year period, the total cost of a properly run trust, setup, 2 periodic charges, exit charge, is around £179,000. The saving compared to doing nothing is close to £300,000. That comparison is what most people never see. Trust advice tends to talk about the 6% charge in isolation, without putting the inheritance tax saving on the other side of the ledger. Once you see both sides, the picture looks very different. The other thing worth taking away from this is timing. A trust set up in your 60s, when you're in good health, is in a much stronger position, both for inheritance tax and for potential care fee protection, than one set up in a hurry at 79. The window is not infinite. It's also not urgent in a panicky way. You have time to do this properly. But the longer you wait, the fewer options you have. If you're in the 55 to 65 bracket and you own a home or have savings that push your estate over the inheritance tax threshold, these are the numbers you need before you walk into a solicitor's office. This channel exists to give you that kind of breakdown. No products, no sales pitch, just the figures. So if you haven't already subscribed, do it now so you don't miss the next video. Trusts aren't for everyone. But if the maths works for your situation, ignoring the option is probably the most expensive decision you'll make. Thanks for watching, and I'll see you in the next one.